It's over. And the switch just flipped. The appeals are gone. The gavel's down. An exchange-traded XRP sits outside the U.S. securities box. That doesn't just clean up a headline. It detonates the floodgates that were welded shut for 4 years. If you're waiting for a louder bell, you'll hear it after the doors close. Here's the shock the market isn't pricing. Within days, a cluster of spot XRP ETF filings hit the docket, amended and resubmitted like drafts that were sitting ready for counsel to say go. Decision windows are stacked for fall, and wrappers don't whisper. They let allocators who couldn't touch spot buy size on day one. That's the difference between interest and mandate. Cards are the second fuse. Gemini is pushing an XRP forward MasterCard rollout with rewards and native settlements, so users earn and spend without thinking in rails. Cards don't make ETF headlines, but they change habits swipe by swipe and spin up distribution faster than PR. The moment the legal perimeter cleared, the consumer channel lit up and started normalizing XRP in pockets. Swift's next digital asset pilot tranche syncs with ISO 20202 hard cutovers, and reports point to XRP Ledger and Hetery entering live harnesses as early as November. Nobody's calling that adoption yet because pilots aren't a victory lap. Policy finally gave U.S. institutions a lane. The Genius Act built a federal perimeter for payment stablecoins with bank-grade issuance and supervision, and market structure language moved from theory to committee text. Darkness sideline risk teams. Clarity flips their math. Internal memos don't say someday anymore. They say pilot, then production. Corridors won't wait for pundits. Japan's remittance lanes already proved the bridge where cents and seconds decide profit versus loss, and that template travels to every market that bleeds on cutoffs. In parallel, banks are piloting tokenized T-bills, repo, and commercial paper for intraday liquidity. Those instruments still need a neutral bridge that speaks bank and carries ISO 20022 data richness across borders in real time. You keep hearing about NDAs for a reason. The exact count's noise, existence is signal. Institutions don't sign paper for fun. Diligence takes months, pilots take quarters, and budget cycles lock the runway before anyone tweets. BRICS countries are wiring options that reduce dollar-only exposure, gold's back as balance sheet armor, and Western markets are tokenizing the safest assets that defend depth and liquidity. In a fragmenting world, a neutral high-finality bridge isn't optional. It's the only way to keep liquidity connected without ceding control to one sovereign. Here's the catalyst hiding in plain sight. Every ETF filing is more than a wrapper. It's a signal that liquidity desks, market makers, and custodians are preparing to run size once approvals drop. S1 updates, fee raises, and authorized participants lining up are the tells that the flows will be real, not just symbolic. At the same time, Ripple's R-Lucid rollout slots directly beside XRP, not against it, a stable coin for balance sheets paired with a bridge asset for liquidity. The point isn't logos, it's latency, auditability, and settlement assurance. Ripple's dollar stablecoin, RLC, sits next to XRP rather than replacing it, stable value for accounting, bridge asset for liquidity. Japan's distribution plan targets early 2026 through licensed corridors with third-party attestations, which pairs cleanly with remittance and treasury flows already in production. Dual-rail design lets compliance bless operations while treasurers source liquidity from the same stack. First, ETF comment cycles, S1 updates, and fee raises funnel into fall decisions. If timing slips, the wrapper stack's still built and refilings are mechanical. Second, card-based distribution pushes XRP into everyday spend and earn, expanding acceptance beyond exchanges and turning utility into habit. Third, Swift pilots post scopes, participants, and KPIs as ISO cutovers harden. Banks that like the numbers scale first because their budget's already anticipated. Parallel to that, watch custody, segregation, and disclosure harmonize across the US, UK, and EU. The stablecoin perimeter lit the runway. Market structure rules let banks treat digital assets like any other balance sheet instrument. Once auditors know where to file line items, inertia dies. Committees stop saying monitor and start saying roll out. Here's how re-ratings really work. Wrappers don't add one buyer. They unlock entire classes that were structurally barred. Utility corridors don't whisper. They print service-level agreements and volumes. When friction disappears for allocators and for operators at the same time, price doesn't stroll upward. It gaps because the demand function changed overnight. Use a better model. Think of XRP as the bridge that makes value programmable across borders, the way APIs made data programmable across apps. Once teams integrate, nobody goes back to manual reconciliations, idle nostril balances, or multi-day cutoffs. Treasury, compliance, and CFO desks all optimize for cost, speed, and risk. And the cheaper, faster, lower-risk pipe wins because it's arithmetic, not narrative. Risks aren't gone, so treat them like pros do. Not every pilot becomes production. ETF clocks can slip, and one bank's risk committee can stall a corridor even when another's ready. The point isn't perfect glide paths, it's the vector. The constraints that kept institutions on the sideline are either removed or mapped to standardized playbooks, and that's why filings, pilots, and launches started clustering the second the case ended. There's a product angle almost nobody's modeling. RUSD lets operators hold stable value while sourcing cross-border liquidity from XRP in the same stack, so finance teams don't need new accounting tricks to move faster. That's how adoption sneaks in, not through slogans, through tooling that makes the right choice the easy choice. When the workflow's better, habits follow and volumes compound. If you're tracking execution, watch 3 metrics in the pilots: end-to-end settlement time in seconds, reconciliation error rates drifting towards 0 because data travels with value, and capital released from nostril pools as balances get right-sized. On the ETF side, track comment letters and fee races. Low-fee issuers win flows every time. For cards, ignore hype and watch merchant coverage. Utility sticks when acceptance is a non-event. Timeline clarity matters. Swiss ISO 20022 coexistence window closes in late 2025, which compresses bank tech roadmaps into hard cutovers. That's why pilot scopes are publishing now, and why corridor PRs will cluster around budgeting cycles. Pair that with the Genius Act's playbook for compliance tables, and you've got a synchronized calendar. Messaging upgrades, stable rails, and a neutral bridge converging in the same window. One more lens for valuation so you don't get lost in tick-by-tick noise. When a bridge goes from story to invisible infrastructure, markets stop valuing it like a narrative and start valuing it like a toll road with throughput that keeps compounding. Throughput across remittance, trade finance, treasury, and tokenized securities isn't optional if you want modern liquidity. If the KPIs hit, the re-rate isn't philosophical, it's mechanical. Here's the bottom line. The case is over, the rappers are queuing, the cards are lighting up, the pilots are scoped, and the laws finally match the tech. That's not a headline, that's a sequence. If you're still waiting for someone to grant permission, you'll be buying from someone who moved while you hesitated. If this gave you the exact map for the next phase, subscribe now. I'll keep pulling the real signals: ETF dockets, swift pilot updates, card rollouts, bank corridor PRs, and NDAs that turn into public contracts, so you're positioned before the crowd sees the pattern. This isn't entertainment, it's execution.